Hello, Warriors. Andrew, Brand, how are you? Jordan, hi, Ryan,
Hey Dale.
Richard, Brand, Shahab, AJ, Michael Weissman, and Sinatra. So, interesting action overnight. Ryan, I thought I'd start with Kman and talk about yen. Is
Good
it
morning,
Friday?
Dale.
Good morning. Is it Friday?
Yeah, it is. It's
Okay.
yeah, but they just misspelled the of the day. I mean, don't worry, it's Friday.
All right. All right. So, we took out that 145 with no follow through.
Yes.
Looks like looks like we want to blow the new highs here.
Well,
think?
I don't know. There's something I noticed this morning walking in is that yesterday during your afternoon, the level where we stopped is dead on the 23.6 of the Bank of Japan meeting low. Not the prior low in the 137s, but that one around the 138, the figure on the 28th of July. The
Okay.
23.6 comes in right where we stopped yesterday. Yeah, I mean, and it's actually flying dollar yen. We can express it that way. It's a big figure, more than a big figure from the highs, from the lows. Sorry.
Yeah, I think Ellioticians would say this was an ABC
Right.
with that this could be a wave 4
Mm,
after this big 3, and one
mm,
more high would
yeah.
be 5.
And the must be said that the JGBs are pretty docile. Yesterday we went up to nearly 70 BPs, and we're already back below 65 BPs, and they're still pretty much following what's happening in the US bond market. I thought yesterday there was a decent case for actually Japanese yields to stay higher, because we had a divergence between the PMIs and stuff and the CPI, but then no way. I think the market tried to sell dollars below 145 and got it around their lederhosen. Yeah, it's still very much a case of interest rate divergence and differentials, regardless what's happening on the side.
Yields, I remember saying I would not be long looking for higher yields up there. TLT actually is on the verge of nice little reversal week to the upside with a higher low.
Yeah,
so
and the thing is, yeah, and there, if that's your play, I think Powell will tell you what to do for the end of the week. No, that's my idea. He will, regardless whether it's right, wrong, what he says. I mean, the market will dissect every word that he says tomorrow. I think he's going to just continue on the same line, because we have all the other data, barring this PMI, which came in a little bit weaker yesterday, but still the composite is above 50. Yeah, he's going to tell us what to do with that tomorrow, I reckon, and then going into the end of August, beginning of September, likely. And yeah, but has to be said that this dollar drop or dip yesterday, some was only a dip, the others was a drop, is being gradually undone. Euro can't make it up above 108.80, which is about my level of where it could start to reverse if we're going above. Cable is holding below 127.30. It's all those little things that tells me the dollar isn't dead until it'll be dead.
No, yesterday, first of all, I was surprised that we had this kind of bounce off this triple bottom.
Positioning.
But I think it's a hope low. Okay. You pound at an area, the more you pound at it, it's like, trying to knock a door down. It may not go the first couple times you put your shoulder into it, but the third time. So, I mean, to me, a breakdown looks like inevitable.
I said it this morning as well. We were trading around 127 on the cable just above, and then we were trading around 108.60, 70 on the euro dollar. Now I was looking at the differentials, the short term on the 2 years with the euro and what the market usually looks at, the 5-year with the sterling. Nothing was supporting a further rebound of euro dollar and cable today.
This is a nice formation too. I mean, it's a 600 pip formation.
Yeah.
So, you would think that we'd at least, retrace to this low, go for the stops here. Thank you very much, Kman.
No problem.
I want to ask Ryan if he thinks that euro pound getting some follow through might be coming out of the woods. Tired of hiking in the woods and looking for some green pasture to rally on. What do you think, man?
It'll be wet green pasture.
Does a bear poop in the woods?
I don't know.
Anyway, what do you think? Yeah, I was thinking about yesterday the way it faded, but came in today pretty good, and we started getting back above this 86, 85, 60. We could be at 87 again.
Yeah, I've got a little intermediate level, 85.70. That's sort of my marker. Get above there, yeah, we might be coming out of the woods, although it's not coming out of the forest.
Okay.
We still got that big range up to 87. We're walking 85, 87 as the wider range. But small steps, get above 85, 70. Then you see a bit of light through the trees. Get above 86, 86.10. You see a bit more, and then we've got to progress. But if we can't, then I still don't think we're done with 85 just yet. But as you say, if it does climb higher, then maybe that is the case.
Okay. Let's move over to risk, because wow, what a day the S&Ps had yesterday. So we got through the throwover line. I think that was about 30. But
I've got to ask Dale, is that a technical indicator you've got squiggled on the right hand side of your chart, or someone left a hair on your computer?
It was just a little bear porn.
I did wonder that yesterday.
Kind of like a bear's fantasy. It's a bear's, and it is a new indicator, and I'm selling it through ForexAnalytix for $999.99. How you want to? Anyway, thanks for noticing. So on the S&Ps though, we did, I remember yesterday saying, wow, it wasn't even a 38% retrace. Well, we've accomplished that, and halfway back we got to there. Yeah. So maybe we're going for this 61.8 up here around 4,500.
Well, we take that 50, which for me makes us neutral right here and now. We've had the drop, we've had the bounce, now we've got the what now move.
Yeah.
Needs to take out that fib, and then the 61.8 is your line in the sand, but we've still got some decent stuff up, 45, 20, 30, that sort of area. But if we can't crack this 50 fib around 44.70s, then you've got to think maybe it might go sideways, or we get another little look at the lows.
Okay, maybe something like this from here to catch up with my squiggly line to the downside.
Yeah.
I know. I think Nvidia is going to be up about $1,000 on the opening today.
At the least.
I think 50, 40,
50,000,
50 bucks anyway.
Oh, right.
Blowout earnings and guidance and all the techs are coming in higher. Microsoft will be up 6. Amazon, only up $1. Nvidia is off the chart, so they can't show it. But
it says we are trading at 508 free market.
Okay, so that's plus 37 from the close, and that's going to be you know, a new high by quite a bit. So another huge gap after the earnings, something, it did this again from up
Yeah.
here. It's an amazing thing. Okay, so thoughts on metals, Blake? You're around, or gold has really been, silver
I'm
really
here.
was.
Sorry, I was looking
That's
for
okay.
I was looking for the unmute button. Hi, how's it going?
Good. How you doing? So
Eh,
silver really skyrocketed.
Yeah, and good morning, team.
Good
Yeah, it
morning.
sure did. I mean, silver's gone bonkers. We were talking about it last night. I mean, you know, the thing rallied like, I don't know, 8-9%, and gold
Yeah.
rallied like 2.
Yeah.
It's crazy, right?
Yeah.
And it really squeezed. I don't know. I haven't traded silver in a while, but man, it has been strong. Gold is concerning me, though. I mean,
It's a
I
weak
thought
rally,
that
wasn't it?
it really just hasn't moved a whole lot. You know,
Yeah.
the 1930 level is a real critical pivot,
Yeah.
and it's been a huge pivot for a long time. And you
There
know,
you go.
we can't even
Fif-
climb back above it. So
That's, I think the 50-day is right there, and it hasn't even gotten there yet. So maybe with the yen blowing off to new highs, we have one more wave down in the gold. And I remember you saying there's a harmonic pattern that comes in at 20.5 in silver. Well, look at this return line, bro. Right there.
It goes
So
down there.
if,
I'm gonna close my eyes and load the boat.
yeah, so I mean, it's no guarantee that we're going to take these highs out. This still could be another failing rally, especially, you know, shouldn't be doing this without gold. And we get one more shot down to where you have the harmonic and my speed line is.
yeah, here I'll show. I'll
Grab it.
Yeah, I'll share with you what I've got here too.
Because
I
the
actually
shares aren't backing up. Look at that. The shares did not back up that big move that we had in silver. You could look at SILJ, AEM. You could look at all of them. They did not keep pace with what happened here.
Yeah.
You need to look at the Chinese yuan to trade silver.
Yeah, I thought it might be the yen, but they're pretty related. Wouldn't you say they're kind of now the yuan and the yen, they look like they have similar patterns? It's just a matter of magnitude.
Yeah,
No?
in a way, but then there's a lot of geopolitical divergence, which
Okay, yeah.
I wouldn't really like to trade the yen on the back of the yuan or so, but yeah.
Yeah.
No, but silver could be.
Yeah, okay.
Silver could be. The people believe in the revival or at least the economical support in China, then stuff like silver is going to take off. We've been saying that for months, right? I mean, silver will need some outlook of some sort, and then it can outperform gold.
Well, it certainly didn't last week if you look at the gold silver ratio.
I think Blake is putting up exactly what's going on there.
Yeah, here's iron ore, and you know, Chris Weston brought it up last night. I wasn't even looking at iron ore, and he's like, yeah, you know, look at the, you know, bounce we've seen in iron ore now. Doesn't look that exaggerated, but it is, you know, showing maybe, you know, the stabilization that we might be seeing in China, which I find pretty interesting. So yeah, I'm gonna actually get out of that. But it you know, silver, I tell you, it has been it's been a massive move. The harmonic that I had, and I'll just draw it out again. I removed it yesterday because I was trying to do some analysis here. It looks like this, right? And you know, are we going down to 20 yet? I don't know. I think Dale, like you said, this is probably where the rubber meets the road, you know, so any move up to $25, see how it reacts up there. Again, I'm not trading it. I don't, you know, I don't think it's very clean. It was clean when we came out of this triangle. You can see this was a perfectly measured move. And once it completed there, I really haven't been able to figure it out. But I will tell you, gold's heavy, and it's trading heavy. 1930 is the you said the 50 DMA. It's right there. It's a big pivot. It's been a huge pivot for like months. So you know, gold should theoretically, you know, stall up at 1930, 1935. But you know what's really interesting is seeing this move lower in like the euro. The euro's just given back everything, not everything, but you can see the euro's given back like about half of the move from yesterday, maybe a little bit more. The dollar yen is at the 618 retracement. You know, it's got channel resistance, comes all the way up at 146 and change if it really wants to stretch its legs ahead of Jackson Hole. And how about Nvidia?
Yeah.
You know,
at 40, 50 bucks.
I mean, you know, Nvidia's opening up at all-time highs. So, you know, above the 618 retracement, how it reacts, 161% extension. I'm sorry. How it reacts at the open is going to be pretty key, I think. You know, but you can see pre-market Nvidia's up, you know, quite substantially. So, but it's not helping risk a whole lot. I mean, it is. I mean, the S&P's up, NASDAQ's up. Well, it was up like, you know, quite a bit, but you can see the NASDAQ 100 has come off just a little, but yeah, I mean, the S&P is basically flat on the day. Might be, and this is one thing that we've been talking about in the ForexAnalytix community. Nick in our chat room, he was mentioning this a few days ago that we might be developing some sort of head and shoulder pattern. So it's possible, you know, going into Jackson Hole, and the expectations are going to be all over the map tomorrow. We're going to see a lot of people, you know, jockeying for positions. Only person that's not going to be doing that is going to be Ryan. I think Ryan's going to be out with his family, right?
Yep.
How are you going to? You're not going to say, "Hey, hold my beer," you know, and as I look at the headlines that come through Jackson Hole.
Well, I think the first big ones don't happen until by 8 o'clock in the evening our time. So no.
3 p.m.
Well, yeah, I mean, let's see, 10 o'clock in the morning.
At 3 p.m.
10. What time is it there?
3 p.m.
3. So see, it's not late. You can have an afternoon beer, like maybe 1 or 2 before you can look at the headlines, right, Ryan?
Yeah, let me think about that. Pub or Jackson's Hole. No, I'm going to keep out the hole.
All right. I'm harassing you. I'd hang out with family too if I had them visiting as well. You know, I just think it's real interesting. I want to talk to you guys a little bit about the data that we got the PMI data yesterday. It kind of fell into our plans. We go, okay, we saw the European Eurozone PMIs come in worse than expected. Same with the UK. Then we're like, hey, you know, if the US PMIs come in worse than expected, we should see the dollar really sell off. And we had a complete reversal. I mean, you look at the daily candle in the euro, and we had a nice hammer off of the 200-day moving average, channel support, you know, 618 of this move here. I'll grab this candle or I'll grab that measurement. 618 off of this entire range. And a great reaction. And, you know, we closed at our highs. Now the euro's given back some of those gains, but there's one thing that I've, you know, that I pull away from candlestick charts, and, especially like daily candles. And I'm going to leave you guys thinking about this for the day. I know it's summer, liquidity is pretty poor, but daily candles and Dale, you probably would, you know, confirm or at least you know, recognize this as well. When you have a really strong daily candle reversal by the end of the session. So, you know, today, you know, just remember this candle is moving. It's red right now,
Right.
but by the end of the day, we should be higher. This is a bullish hammer. And so I know you're seeing a pullback in the euro right now, but I think by the end of the day, we'll probably be trading back at 108.60 or 70. There's a higher probability of it. I would say there's probably about a 65 to 75% chance of that happening. And I know it's hard to say that when you've seen the euro just pull back, you know, whatever we just pulled back, you know, I don't know, pretty slow moves in the European hours, and then all of a sudden we got a good 30 pips lower here as North America came back in. But I think by the end of the day, we'll probably be trading a little higher in the euro, so or at least at near break even.
Yeah, and if not, that would be a pretty negative signal of no follow through off that candle.
Right, right, and
like this, right?
Yeah, I mean, let's also just identify that we've been in a pretty strong downtrend in the euro for the last.
You know what? That's
month and a
something
half,
else.
too.
Before I got into FX, people said, I traded currency futures, but they always had the reputation of being the best trending markets technically out there. And this is a perfect example. You really never had major retraces all the way down. We get used to looking for them because, things were pretty choppy for a while. But from 112, it's been basically, you've had two decent counter trend rallies to sell off news. That one and the week before, and that's it. You just had to stay short and not get cute. And
I think the reason why that is, and I'd love to hear what you guys have to say about that, about this, but it would be because monetary policy moves like kind of like a Titanic ship, right? It's not every day you have
inflection points.
Yeah, exactly. And central bankers aren't, they aren't going to shift gears really quick unless you're Alan Greenspan. They're not going to shift gears really quick. So, I think that's why trends tend to stay, intact, because macro trends and, interest rate differentials tend to stay, divergent or converging for a long period of time. Ryan, you got any feedback on that?
No, I agree, mate. The market's all about looking for the next turn, and I still think that's coming Q4-ish into next year. That's when we'll really be trading potential rate cuts. Might even start after Powell once we get the summer out of the way, because Powell's going to do one or two things. He's either going to give these moves in yields and the dollar more rope by not saying an awful lot, by not showing any worries about it, or they've got some worries about it, you're going to tap it on the head. So I favour the former. So I don't think we're going to see any difference from Powell, and it might give yields that shot in the arm to try another leg higher.
So what do you guys think about the cable here? Let me ask you this. I was just giving you a little bit of a drawing of what might happen, especially if you have Powell that is hawkish. Let's say he comes out tomorrow swinging, and just was really, really hawkish and doesn't give the market anything to chew on. You see stocks come down, you see the dollar really rally, and cable's, trading at range lows right now. You can see it's, right at it's a 618 retracement. You can see it right over here, 126. Let's say we break 126. Do you see the cable really starting to weaken? I mean, you guys live in the UK. What do you guys think there?
Well, we only know the pound in the UK, so we don't trade it. But if it breaks 126, you're probably going to see a decent size move. 120, I don't know. It's going to need a real turnaround in economics, in the fundamentals, and the BOE to see that. But it's possible. It's a threat I've been warning about for a while now. The BOE could, the UK could be the poster child for what happens when you hike rates too high too fast.
Right. What say you, Kay? You live in the UK. What say you?
Yeah, I do. No, I think it's a pretty important level, and at least technically, and probably the model funds will get triggers if we break down there, so we could have a real quick move lower. But at this point in time, I can see it happen. I can really see it happen because, as I said, the sterling traders or trading the sterling is, and I've seen that over my career, it tends to get quite emotional. So especially if you start to break those kind of levels, and then I think people will try to sell it pretty hard. But then there's the other side of the middle, and the other side of the pair is the dollar, where we don't know what's going to happen. Well, I don't think tomorrow Powell is going to rock the boat too much, but imagine that we have a bit of continuation of what's going on now, and we may break there, and then next week we get a very bad labor report, which perhaps is going to happen or bound to happen sooner or later. But I think we need to be careful when we trade breaks at this stage of the year. And I'm trying to, at least. I'm okay to trade the break if it comes, because it's probably will have legs. But then once you have traded the weak Bank of England, are you continuing to sell it, yes or no? That is always the question right here and now. And I think we're really entering a period of the year where we have to be a tad on our toes for whatever can happen. But if you look at the interest rate differentials, it should go lower, actually, the cable, because we are at relatively dangerous levels, very close to parity on the 5-year. If that breaks, that should really put a lot of pressure on the cable to the downside.
All right. Yeah, and yesterday speaks to your point about you got to really be careful chasing the market. The dollar index was a great example of yesterday at this time. The dollar index was breaking out and, into fresh highs, squeezing everybody that was, that was short, getting the market really excited. And then those PMIs came out and it really sank the dollar index. Speaking of the dollar index, I think the dollar index is pretty well defined as far as where the bulls reside. It's this black line. You can see it right here. And I'll even make it, more of a dashed line so you can kind of see it. That has clearly defined this uptrend since the dollar has been rallying, and it's been a nasty rally. I mean, I know we talked about it a lot yesterday amongst the ForexAnalytix community. This is the US dollar exceptionalism story that has kept the dollar just ripping into highs, and people have been, it's gotten a lot of people wrong-footed. Now, whether we continue this breakout or whether we reverse back into this range probably has more to do with, Powell and the Jackson Hole, the messaging that comes across. But it's going to be really interesting as we head into this fall, because this fall, and I don't want to dismiss the fact that you look at the equity markets. We'll look at the S&P since it's the broader markets here. We are making a lower high, and on a weekly basis. For all the people that have been calling for a melt up and all-time highs, and they've been kind of shown out the door the last month, and the last month is really signaled that the S&P is in more of a consolidation. We head into the second half of the last part of 2023. We're going to be facing, as Kman just pointed out, a lot of economic data, which probably is going to start showing, the U.S. economy is slowing, whether it's on labor markets, whether it's production, whether it's exports. We have the piece. Actually, wait, hold on. This morning, we have weekly unemployment claims, and we have actually durable goods orders coming up in just a few minutes. So it's going to be a really interesting September. And I think this September, there's going to be so much volatility. So with that being said, if you guys haven't checked out the trader funding program, you should. Actually, it was really cool. Last night I was just kind of, wrapping up things, getting ready for the trade-off, and, Bitcoin blew up to the outside, and I saw a couple people pass, and now they're trading our money. And I'm like, man, they must have been long Bitcoin right there, because off of the 25,000 level, because it was a big key level of support. Anyway, if you want to learn about trading our capital, make sure you check out the trader funding program. That also gets you inside of the ForexAnalytix community while you're passing your assessment, at least for a period of time, depending on what account you try. So make sure you check out the trader funding program. You can find it right on our website. All right, let's go over to the data flash here. This is included with ForexAnalytix, so we can see the data coming out. We have weekly unemployment claims, and we have durable goods orders coming up. We have just
10 seconds before the release.
Well, we got 10 seconds just before the release. I don't know if you guys could hear that, but did you hear that?
Yeah.
Yeah. Okay. That audio, I must have accidentally clicked the audio thing. All right, here we go.
Down
Oh,
5.2.
we
Jobless.
Strong
sorry,
durable goods.
Yeah.
Yeah.
the
Strong durable
orders are
goods.
lower. Oh.
Have you guys seen the weekly?
Yeah,
Yeah,
the jobless claims are it's okay, no dramas, nothing. Moving on.
Okay, it's okay. Nothing like to worry. Oh, 230,000. Not bad. Not bad. So a little bit of mixed signals here. Dollar index is firming. You got the euro that's actually pushing new lows. Dollar yen's pushing new highs, and equity markets are not really moved. You know, it's interesting. Good data. Actually, you know, and we were looking at the PMIs yesterday, and Kman, I know we were talking about this right at the end of yesterday's show. Good data actually translated into a positive equity market move. I wasn't sure if it was going to do that. I was thinking we might get the opposite, but yesterday, good data. Stocks
They were slightly on the weak side, the PMIs, right? But then the yields came off a little bit, but I think there's a lot of NVIDIA in this move, no?
I'm sorry, bad data meant I said that incorrectly.
No,
It's
that's
still
okay.
5 a.m. So yeah, the poor data I thought would equate to weak equities, but it actually translated into strong equities still. So
I think it's a lot about NVIDIA expectations as well in there.
Yeah. So, all right, guys. So I want to say thank you all for being here, but you guys need to stick around because one of my favorite Wyckoff people is here, and the Wyckoff. You got Bruce coming in, don't you today, Dale?
Yeah. Can you help me promote him? It doesn't.
Let me see if I can find him here. Yeah, let me see if I can grab him really quick. And you guys stick around because he's a really nice guy. Oh, here's Bruce. So let me see if this works. And you guys should stick around because he'll be a great interview with Dale. So
yeah, especially at this, you know, is this a correction? Could it be more? Let's see what Bruce's work is saying because it's usually clarifying for me. So Bruce, welcome back to F.A.C.E. Thank you, team.
Gosh.
Thanks, team.
Yeah. Hey, Bruce.
Cheers,
how are
all.
you, man?
Thank you.
How are you?
I'm great. Thank you
Good.
all. It's great to hear your voice. It's always fun to listen.
You have fans here.
Oh my gosh. Well, hey, I'm glad to be here. And I was going to hitchhike on a couple of the comments that Blake had made to start. But anyway,
Okay.
you're in charge of this railroad.
No,
Dale,
no. You can take it wherever you want. It's still America.
Well,
you can take control of the screen and say what's on your mind, Bruce. People have heard me blather for half an hour already.
Let me know when you can see my screen.
There we go.
Now I don't follow the currencies the way you all do, but I do follow them and more of on a long-term time basis. And you can see this chart on the left, which is just a lot more data. And I'm using the UUP, comparing it to gold because I just want to compare the relationship. And you can see there the inverse relationship between the dollar and gold. And of course, you all were making the comment about how poorly gold has been trading. And you can see that the dollar has just been, stellar here since early July. And this is after, so big context, now we'll get a little white coffee in here. Distribution form back in 22, big leg down. Basically, we're range bound. So we're sitting here range bound in the dollar index. And we've just up thrusted these highs. This is a really interesting place, and something I thought yesterday was a very important day on a number of different fronts. And I think the dollar was maybe the anchor to the whole thing. And so,
when it weakened and yields weakened, everything reversed and risk on happened in a big way.
and I think there was a reason for that, Dale. And so if you go over just a little more granular, you can see on the right, you can see that we're just looking at fewer days here. But and admittedly, the gold chart is not updated for yesterday because it's an end of day chart. I did it yesterday, but as we all know, gold was up a little, silver was up a lot. And this was an outside day in the UUP. And I'm very curious whether it can go back down through this very important resistance zone. And this is still resistance. And Wyckoff would call this an upthrust. And if this is redistribution in the dollar, this could be an upthrust after distribution, we call it, in a redistribution formation, which has been going on for. It implies that it's a continuation structure and that we should get follow through to the downside that approximately matches the move that we had there off that very sharp climactic peak in 2022, September, end of the quarter. End of the quarter is very important to me. So anyway, all we can do is just see whether or not it shows weakness back through that level. And if it does, then very interesting. But a couple of things that happened yesterday, and now I'm getting a little off the technical, but in the Twitterverse, I don't know, or the Xverse or whatever it is, you know, we'll all recall the banking crisis that we had in the spring, and the banking crisis, which was very just, you know, very difficult, disturbing for the market, but I think it created a bit of a reflation trade, and was really helpful to the market. And so here, this was one of the tables. Now I'm not going to, you know, we're not going to go through this, but one of the tables that was coming up, some very good analysis. I wish I could give you the person that did this, but it's based on Federal Home Loan Bank Board data. So it's an FHLB spreadsheet. And you can see those three banks in blue are the three banks that failed in the spring. And so if you look at FHLB loans to these banks, that Charles Schwab Bank, and I don't want to cause anybody to panic here. I don't think this is a big, I don't think this is necessarily an imminent problem, or maybe never a problem, but it has a very high debt as a percentage of their equity. And now keep in mind, Charles Schwab Bank is not Charles Schwab Brokerage. Charles Schwab Brokerage is many, many times bigger, but Charles Schwab as a bank is quite large. And I think that there was all this buzz in the Twitterverse. And this buzz, I think, was something that may have set up the trading for yesterday. Because
you mean the turn in the bonds and yields coming down. You know, this is an interesting table, and maybe you could answer this question. So I'm looking at this table right here, and I've been very negative Citi and most of the banks. In fact, it's part of my bearish narrative. Citibank is a pretty low compared to others, 11%.
Yes.
And it's pressing new lows if you've looked at Citibank. So it's not just the regional bank chart that looks negative. The XLF looks like it broke down, and Citibank, if this isn't the problem of leverage, what is Citibank's problem that it's almost back at the COVID peak or low?
Well, and you know, I think that the banking business in and of itself is not been a great business to be in, obviously. And Citibank, I think, has a lot of legacy loans in there.
The derivatives from 08 that never were just put somewhere in a box.
And other banks have similar problems. So these other banks have got some derivatives that, for instance, a big big derivative exposure in the silver
Okay.
market.
Okay,
And
so
so-
that it's not just duration risk. There's
No.
all kinds of leverage risk.
And a lot
with
of these
money centers.
a lot of these banks, especially the money center banks, which are receiving the assets, like Silicon Valley Bank, First Republic,
Right.
they got folded into bigger banks. Well, the
Right.
other thing that happens with these bigger banks is that they get their loan portfolios and they get their other portfolios. And so there is, you know, the bigger bank that receives these assets has to work them out of their portfolio. And in some cases, they were maybe the reason why the smaller bank got into trouble in the first place, is because they got upside down on these very, very large trading positions. And
Yeah,
in
long
addition,
bonds.
well, and long bonds is the big story. That's what brought down these three
Yeah.
banks in the spring. And
Right.
so, and that's because of Fed actions, because of what the Fed did. And
And then
so-
don't you think that Powell knew what he was doing, that these banks were vulnerable with the regime he embarked on?
oh, there's no question. That's their job. You know, they're
So
supposed to be.
why is he trying to kill the financial system and clear out all these banks? Is it for the introduction where people have no confidence in their own banking system that they'll accept the CBDC as a fix, Bruce?
Well, I've certainly read a lot about that, and I'm just not. I mean, I know some very smart banking people that are concerned about the possibility of the CBDCs, and I've tried very hard to understand, you know, exactly what they're proposing. And
How are they going to sell it unless people have enough fear or under enough duress to accept it as a fix?
well, and that could be where if there is a larger banking crisis. But I think what may have happened yesterday, Dale, is that the Fed learned in the prior crisis in the spring that it's better to head off a disaster than it is to react to it. And that was the whole strategy with Greenspan, is he says, well, you know, you can never anticipate where a market is extreme overvaluation. So you have to let the market go up and then break and then deal with, you know, the aftermath. That was sort of their philosophy back in that era. Well, here, all of a sudden they discovered that, my gosh, these are three really big banks and this is contagious. And they had to solve the problem in a very expensive way after the crash of those banks, a crash in the banks, not in the market. And so I think what's happened here is I believe that the Fed is very attuned to the subtext of what's going on, and they're seeing that there's still some very, very big banks, which shows up in that table, that have exposure that's comparable to the exposure that these other banks had in the spring. And this time it's better to head off the problem. And I actually think that what we may see, because the bonds yesterday were up more than the NASDAQ.
Yeah.
The long-term bonds
haven't
were
seen that in a long time. TLT up over 2 points.
Oh my gosh, it was, yeah. And then a big outside day in the UUP, big day in gold. So you have gold, silver, big, huge day in silver and a huge day in the bonds. They normally work opposite of each other. And so I think that maybe what the market was anticipating is that we're going to get maybe the Fed is going to back off their extremely negative exposure.
Hawkish.
Yeah, but they're not going to come out and say that necessarily. It may be vaguely in Powell's language tomorrow, but he's still going to talk tough, but I believe. But at the same time, there could be underlings, or there could be other board members or other ways that they communicate that they have, that interest rates, they may stop and watch for a while. And I don't think by any stretch of the imagination that interest rates are going to start to go down. The only history shows us that the only time the Fed starts to cut rates is because they're following the 2-year yield down because the economy is in recession. And so you can see, for instance, in this chart right here, which is the yield curve, note that this is the spring right here. And look at how negative the yield curve got around the time of the big banking crack up. And it was over a -1% negative yield curve. So almost 110 basis point negative yield curve. And so, and this is 10s to 2s. And so now why is that significant? Why is a negative yield curve important? And this is the other point I would make here with this chart, and then I'll show you another one, is that look at the rally that's already started since the beginning of the third quarter, which is that you have a yield curve that's still negative, but it's
starting to steepen.
It's starting to move back towards normality, and not that it's going to get to positive anytime soon. This yellow shaded area just represents negative yield curve tight money. And tight money, Blake said it there here towards the end. He said, you know, it's like the economy looks like it's still trying to weaken towards recession. And in fact, I think that is inevitable, is that sometime probably next year, because these things move so slowly, that we are going to have some kind of a recession. It might be mild, and here's part of the reason for that, is that if you look at this is the Fed data, and Cleveland Fed does great work on yield curve. And in every case, going back as far as they've studied, I believe, you know, you'd have to go look, this data is all there for you to look at, is that a negative yield curve has resulted in a recession, which is the gray areas.
And this is the most inverted since 1980.
Yeah, there you go. And so here's the history all the way back into the 70s.
Than the other crash, the other crashes.
And so this likely is going, now, you know, because of the Inflation Reduction Act and other things, the federal government does have money to infuse into the economy, and there's some pretty smart people that are saying this is helping to keep GDP in you know, above zero. You know, that the economy is still bumping along.
Atlanta Fed is talking 5% GDP.
Yeah, and I guess there's some like statistical reasons for why we could get 5%, and they think some people think it's just a bit of a blip, but I don't see that a recession is like in the cards for 2023. But as long as the yield curve, and the thing is that the yield curve, note, Dale, that the yield curve goes positive in these cases before the recession starts.
Okay. Yeah.
And so it's a very slow moving train. And then I think that the analog is here, which if you look at this analog 2018 to the present to back in the 70s, 60s and 70s, there's very eerie similarities. Inflation was very low in the 50s and 60s. When the 60s got going, inflation started to ramp, and eventually it doubled and tripled into the late 60s. But as we know, and I was there, the CPI numbers just continued to go higher all through the decade of the 70s. And so I believe that we may be seeing something similar to the decade of the 70s coming, but that we're still relatively early in the game. So what I've done here in this data, 2018 to 23, which includes the COVID low, which I have lined up to the 62 market low, look at the correlation, look at the analog that sort of shows up here, and look at how we had this rally from 66 to 69. Well, this high right here was right into the 68 presidential election.
Interesting.
Nixon's first term,
Yeah.
just almost reached the highs of the bull market, which
just like recently.
yes. And
Wow.
so
that is really a cool analog.
Two-stage advance. And I think it's very possible that we could have this market at new highs, the indexes. And now I'm just looking at the Dow here, but does it, NASDAQ, S&P, that these major indexes could easily be at new highs. But this is the big story, I think. The reason that inflation started to heat back up again in the 70s was because the Fed back then was alarmed about inflation, but then they backed off their policy, right, because it was too hard on the economy.
Yeah,
and
Paul's nightmare. Yeah.
And so if there's a bit of a pivot here, because they're worried about the banking system and they don't want a replay of the spring, and they're already doing things behind the scenes to make sure that we have a smooth ride through here, because banking is all a confidence game. And when Twitter started to explode in the spring, and right when Twitter exploded with these, all of these stories, is when there started to be a run on those banks. And so this is what the Fed wants to head off, is a run on the banks. And so I believe that's, that would be their normal response. And so I wonder if the Fed is quietly and carefully going to, or is already starting a pivot, which is shown from evidence like the yield curve starting to moderate.
Okay. Well, if it's starting to moderate and head up, that's a negative sign, according to the analogs we've seen.
Well,
that's when the recessions start.
Well, they're moderate, but they've already done the really, heavy lifting of tight money policy. So they probably put a recession is baked into the cake. And so, but that doesn't mean, just like we had in the late 60s, that we don't have a reasonably good advance in the market for a period of time, and maybe even get to new highs. And so, okay. Blake had made that comment earlier. It's like, well, you got to be careful here. And I agree with him, because we're very close to the prior highs that were made back in 2020, 2021. And so here we are, we'll have a secondary test of this prior high, and even an upthrust of that high could just indicate that we're in a big range bound condition. Classic range bound structure that went on for more than a decade.
All right. Can I address what I think may be the elephant in the room? I know we're talking about cycles and what's in the Fed, and the Fed is the main idea here. Can I talk about that China? The narrative is what they've done is weak in response to the economic weakness the country has, just those two interest rate cuts and devaluation of the yuan. And all of the Western central bankers are saying you have to do more, do some fiscal, do QE like we did. And is it possible that Xi, who doesn't face an election, is willing to accept the pain of a deflationary impulse to drag us down, just like they really took us out of the 08 recession by being the only engine of growth, that China is bigger than the Fed right now, and what happens there?
Well, I thought it was real interesting that China did pivot to a more easy money stance, and they have a tremendous amount of debt in their system, and so their debt problems, I think, exceed really anybody's. And right. So I guess
the point is, if China could drag us out of weak growth like it did in the Great Recession, could it take us down You know, America
Well-
would get a cold, the rest of the world will get pneumonia. Maybe
Right.
it's now China. If China gets a cold, the rest of the world gets pneumonia.
Well, and the thing is that if they continue to follow, right now they're kind of pivoting towards easier money, and so it's a first step, let's say. But the thing is that the thing about monetary policy is it tends to be a worldwide phenomenon, and normally the Fed leads the parade. And so if the Fed is getting tighter than and of course you can look at Europe, their inflation problems are even worse than ours, and so on. But if the Fed all of a sudden signals, and they all talk to each other, that they're going to pivot towards a more accommodative stance, then, and here's China.
Do you think the Fed communicates with the PBOC?
I can only guess
don't
about that.
I
I don't know
I
either.
mean, they
Yeah.
don't communicate in any other way, militarily or anything. They don't pick up the phone. So
Yeah.
I don't know. It's pretty opaque.
Yeah, but I do think that like the G, however many there are, 7, whatever, I think all these big central banks are
they do.
all in cahoots with each other.
Yeah, it's a
And
club.
it very much. And so tight money, easy money, it tends to go together. And so if we start to see a bit of a pivot from Powell, you're probably going to see that in the other major central banks also. And so now we may learn a little something tomorrow. I think he'll still be hawkish in his comments. It's more about what they do behind the scenes. And we'll probably learn that in a month or two, but the markets will react right away. And because, if they're pumping, high powered money into the system, that we may have seen that yesterday. And so
go ahead, Bruce. I'm sorry.
No, go ahead.
The US dollar yen will tell you where rates are going.
And a couple of other things. I know we're running out of time.
It's okay. Take your time.
So here, for instance, this is a chart I really watch closely, and it's the and I show this on Power Charting, which is a show that I do for stock charts every week. But this is the New York Stock Exchange 50-day stocks above their 50-day moving average. And this is the NASDAQ stocks above their 50. And the one thing you'll notice here about the NASDAQ is that look at how really less vibrant the rally was in May, June, July. I mean, it still got up into the 60s, low 60s. But, this, I think, was all the mega cap growth stocks.
Of course.
The money, like what happened yesterday. And NVIDIA, NVIDIA is now, very much a mega cap. And then also over here on the New York, you can see that got up into the 80s. So over 80% of New York stocks, which used to be the blue chips, but now they're kind of teeny tiny compared to the mega caps that are dominating the NASDAQ. And they're also dominating the S&P index and other things. But what I look for is I look for divergent characteristics at key highs and lows. And that's one thing is, so you can see here, DNC, downside non-confirmation. And that means that you have, like here, for instance, this is 22, but this is June, July, a divergence. You have two lows here, and look at the stocks above their 50-day rising. Internally, that's showing improvement or repair underneath the surface, and it led to a really dynamic advance into the August peak. And you can see that happening in October, which was a great trading period, beautiful divergence. We had a really nice divergence in May of this year, and that led to a nice advance. And now you can see, look at a blow off, and then there early July, right into the beginning of the new quarter, divergence, upside non-confirmation against higher prices in the NYA index. Well, and in the NASDAQ, you can see something similar occurring, where it sort of built a top at a lower level, less breadth in the NASDAQ, and a really big blow off in the NDX. So I think that best case for the NDX here, just, looking talking Wyckoff, July, right at the beginning of the new quarter, we had a climactic surge. This is an automatic reaction in August, which says that we're range bound between these two extremes, more or less. We'll be bounded by those for a few months. And so we may fiercely rally back up to the resistance level, maybe even get slightly above it. And then I believe that it'll come back in and be in a trading range. And then this is my seasonality chart for 2023. Works so well in 22, but here you can see that it worked really nicely. This is the S&P, and look at the how we had upward theme to seasonality in the first half of the year. Starting in August, we get weakness, and then range bound until November, December. And we did have weakness in the first part of August. And so far it's, following the script. And I just believe that this is going to be range bound for stocks. But I think that the theme is rotation, that there's going to be some great rotation. And we saw that yesterday. I think we may have seen some of the early evidence of rotation. So
you're sanguine. A little bit of a pullback, but Bruce is pretty sanguine about the market here. So go ahead.
Yeah. Oh, and
that
I was
funny?
just yeah. I like sanguine.
All right. Throw some sugar in there. All right.
This is the S&P, and this is a messy chart, and I apologize, but this is my working chart. This is the one that I label it. I put all my stuff. This is my distribution notes. I actually showed you this chart back in early 22 when the bear market was just getting, some legs, and we talked about it. And and then I just keep updating as we go. Beautiful accumulation structure came out. Now we have, look at this big trend channel. And so we have the October low, beautiful divergent characteristics at the October low, beginning of the quarter. And then from the March low, this sets the stride for the advance. Well, look what we did. We went right up and we draw on the intervening high, we draw the parallel, and went right up and touched it. And when we touched it, you can see down here, stocks above their 50-day divergences are showing up at the time of the touch. That's an overbought market. And now it's working its way back into old resistance, new support, hopefully. And then the only other interesting thing here is,
so this could just be a correction to about 4,200 and then go again.
Yes, absolutely. And then here you have the NASDAQ 100, which is dominated by the mega caps, did not get to overbought like the S&P did. And we saw that the internal divergences it wasn't strong in the NASDAQ. But what was strong, this is the NDX stocks above their 50-day down here, this oscillator. So this is just the really big leadership names, and it got almost to 90% of stocks above their 50. But look what we've done here. In August, we weakened back down. Oh, sorry. And went back down to what we call the demand line, the green line, and touched it. Now we're rallying.
All right,
So,
let's wrap it. Let's see that point and figure you tried to hide away.
Yeah, this is good.
One X and O. All right. All right.
This
so
is good. Only because it's two segments. This is the accumulation structure in 22,
right.
23.
Okay.
Here's the target at 388. We got two 100s from hitting the target. So that's a hit. And but the more important thing, if we take the second segment, we get higher price objectives in the triple Qs, which is really the NASDAQ.
Really high.
So
yeah. So these recent exits down don't change anything.
No, I think it sets up. a reaccumulation structure that may ultimately, when completed, give us a confirming count to this 532, 564. That's what I'm looking for.
Oh,
whether
Bruce,
that
Bruce is a melt up guy. All right.
Well-
Anyway, anyway, don't have any, don't have any ice cream. It'll get all over you.
no,
It'll
it'll
melt
it-
up on you. So,
instantly.
Bruce, great looks, really, and nice analogies and excellent presentation. Thank you so much.
Always a pleasure to hang with you all.
Yeah,
yeah,
really. Yeah, great work. And follow Bruce on Twitter, X at RD Wickoff, and go watch him on stockcharts.com. He does some great work there, and puts out a lot of great research. And what's your website again, buddy?
WYCOFFanalytics.com. A lot of good Wyckoff work there that's free. Yeah.
So learn
And
from
my
Bruce.
blog, my written blog which has a lot of great Wyckoff content on how to do it, is stockcharts.com under articles.
Okay, so he's a
Yeah.
writer too. I don't know, what a
Barely.
renaissance man. Okay, well, Bruce, nice talking to you, buddy. I hope you
Oh
have
my
a,
gosh.
great rest of the summer, drawing to the close, and an excellent fall, and look forward to us
Thank you, Dale. And
reuniting again.
best to you all there. Always fun to get together.
Bruce Fraser, everybody. Thank you very much, Bruce.
Take care, everyone.
Great presentation. Watch this video again, guys, and you could join the team in 9 minutes for the morning edge. Don't just count your pips, count your blessings. And Melt Up Bruce will be back with us in December, right before Christmas.
With my ice cream.
All right.